Welcome back to Talk Tickers. We are the professional earnings summarization show for the serious investor.
And today, we are stripping the noise out of a report that, frankly, gave the market a serious case of whiplash.
Yeah, that's putting it mildly. We're looking at Invesco, ticker IVZ. The report hit the wires Tuesday morning, January 27th, 2026.
And if you were just watching the tape, it was confusing.
It really was. The stock popped right at the open. It looked like a classic B, and then it just faded hard.
It closed down roughly 5.1% at $27.16. A really rough session.
And a drop like that, you immediately assume the worst, right? You think they missed earnings, guidance was a disaster, assets are just fleeing the building.
But that's not really what happened here. This was a total battle between a headline disaster and, well, an underlying beat.
It's one of the strangest I've seen. You've got this massive GAAP loss, just a sea of red ink. But then management is out there telling a story of milestones and record assets.
Unlocking value.
Unlocking value, exactly. So that's the setup for this deep dive. How does a company grow its assets under management AUM to a record $2.17 trillion?
And pull in $19 billion in fresh inflows.
And still drop 5%. We are going to unpack that massive $1.8 billion impairment, the monetization of the QQQ, and their exits from India and Canada.
There are a lot of moving parts. It's messy. But, that's usually where the opportunity is.
All right, so let's start with the snapshot. Give us the high-level numbers that made the market just blink. The ugly headline.
The sticker shock was real. I mean, if you just looked at the GAAP earnings per share, Invesco posted a loss of $2.61.
Wow. And compare that to last year?
A profit of 46 cents. So if you're an algorithm scraping headlines, that looks catastrophic.
It looks like a crater. But we have to be clear here. In finance, a loss can mean money actually leaving the bank, or it can mean an accountant just changed a number on a spreadsheet. Which one was this?
It was strictly the spreadsheet. The culprit here is a massive non-cash intangible impairment charge. We're talking $1.8 billion.
Okay, let's break that down, because non-cash intangible impairment just sounds like corporate speak for, we made a really bad deal a few years ago.
That's exactly what it is. It's an accounting cleanup. Think of it like you bought something for $1,000 years ago, and today you have to admit it's only worth $10.
You have to write it down on paper, but the cash was spent long ago.
Precisely. And that $1.8 billion charge is what wiped out all the profitability on paper. It drove their operating margin to, get this, negative 86.2%.
Negative 86%. You can see why the algorithms hit the sell button before a human even read the press release?
Oh, absolutely. But again, this doesn't impact their ability to pay the bills or buy back stock. It's just history catching up with the books.
Okay, so let's grab the eraser. If we wipe that charge away to look at the real operating business, what do the numbers look like?
The adjusted picture is, well, completely different. Adjusted EPS came in at 62 cents.
And the street was looking for what?
58 cents. So that's a beat, a solid beat of over 7%.
So let me get this straight. The actual machine that manages money and collects fees is performing better than anyone thought?
Yes. And revenue was up too. GAAP operating revenue was up over 6% year over year. Adjusted net revenues also beat.
And the assets. You said they were at a record. If the business was failing, customers would be leaving.
They're flooding in. AUM ended at $2.17 trillion. That is up 17.5% from a year ago.
And the flows?
Positive. $19.1 billion in long-term net inflows for the quarter.
19 billion. You have to stick a pin in that number. That is not a dying business. So, if flows are good, adjusted earnings beat, why the panic? Why the sell-off?
Because the market hates complexity. It absolutely hates it. You have this messy impairment, a really complicated expense guide for next year, all these asset sales. The market basically said, this is too hard, sell it, we'll figure it out later.
The too hard pile.
Exactly. But we like the too hard pile.
We do. So let's put on our hard hats, because there's one thing that happened in Q4 that changes the entire economic engine of this company. Let's talk about the QQQ.
The crown jewel.
For anyone who doesn't know, the Invesco QQQ is the massive ETF that tracks the NASDAQ 100. It is one of the biggest, most traded funds on the planet.
But Invesco's relationship with it was always unique. It was structured as a unit investment trust, a really old school setup. They were more like caretakers than owners. They weren't capturing the full economic benefit.
Until December 20th, 2025.
Right. They completed the conversion to an open-end fund ETF. This is a massive structural change. It means Invesco now earns actual revenue and profit on that $400 billion plus asset base.
They flipped the switch from prestige project to cash cow.
In a way, yes, but it adds some complexity to the P&L. So it adds about 18 basis points to their management fees.
Okay, 18 basis points on 400 billion is a lot of money.
It is huge on the top line.
But
it also increases what they call third-party contra revenues.
which are basically costs netted against revenue, right? Like licensing fees to NASDAQ.
Exactly. Licensing, custodial fees, things like that. Those go up by about 12 basis points.
So 18 in, 12 out. The net benefit is closer to a 6 basis point spread.
Roughly, yes. But here is the catch, and this is probably another reason for the stock's weakness. The marketing costs.
Right. We see the QQQ ads everywhere, NFL games, financial news.
And now those costs hit Invesco's P&L directly. The CFO, Allison Dukes, guided that to be in the $60 to $100 million range for 2026.
Ouch. So you get the revenue stream, but you also get the bill for the Super Bowl ads.
You do. But the bet is that by owning the whole structure, they can drive more bottom-line growth over time. It's a structural earnings power argument.
Makes sense. Now, speaking of structure, let's talk about the balance sheet. Management could not stop saying strengthening the balance sheet.
They were very focused on it, and they backed it up. In Q4, they bought back another $500 million of that Series A preferred stock from MassMutual.
Bringing the total for the year to
$1.5 billion. They're aggressively getting rid of that expensive capital.
And they paid down other debt too, right?
Yep. Repaid the final $240 million of a term loan. So their leverage ratio, which is what you really want to watch, is down to 2.2 times. A year ago, it was at 2.8.
That is a big deal. Why should the listener care about 2.2 versus 2.8?
Because it takes the doom scenario off the table. At 2.8, you start to worry about debt covenants in a bad market. At 2.2, you're stable. And it frees up cash for shareholders.
And that's the plan. They're ramping up common stock buybacks to $40 million in Q1, targeting a 60% total payout ratio.
So the story is clean up the debt, then reward the common shareholder.
But to get there, they had to do some house cleaning. A simplification spree, as they called it.
Right. CEO Andrew Schlossberg talked a lot about selling off the parts that don't fit the core engine.
What did they sell?
They completed the sale of Intelliflo to Carlyle. That's done. They sold a 60% stake in their India business to Hinduja Group, making it a JV.
And Canada.
Canada's interesting. It's a strategic partnership with CI Global Asset Management.
Now, this part caught my ear in the Q&A. This deal isn't immediately profitable, is it?
No, and this is another one of those messy details. The deal closes late Q2 2026, but it will actually result in a $5 to $10 million operating income drag starting in Q3.
A drag. Why sign a deal that loses you money at first?
Sticky comp expenses.
Yeah.
It takes time to unwind all the personnel costs, but the revenue sharing part of the deal changes immediately. They say it becomes profitable in 2027, but for this year, it's a headwind.
This is what I mean about a kitchen sink quarter. You've got the impairment, the new marketing costs, the Canada drag. 2026 feels like a big transition year.
And the expense guidance reflects that. It was convoluted.
Let's try to build the bridge for the listener. Where do you start?
Okay, you start with their Q4 annualized expenses. That's about $3.2 billion. That's your base.
Okay, 3.2. Now add things.
Add the QQQ marketing, so 60 to 100 million. Then add another 25 to 30 million for what they're calling a hybrid alpha platform implementation.
Which is just a fancy way of saying they're upgrading their tech.
Exactly. Necessary, but it costs money. Then you take out the expenses from India and Intelliflo since they're sold. That's about 100 million combined.
Okay. And where does that leave the comp ratio?
They're guiding to the high end of the 38 to 42% range. So, yeah, expenses are sticky. They're spending to modernize, and the market wants to see savings now.
Which brings us to the bigger context. Why do all this? Because the ground is shifting under their feet. The war between active and passive management.
It's the defining narrative, and you see it right in their numbers. Their ETF and index strategies pulled in $11.9 billion.
Almost $12 billion.
Yeah.
And the active side.
Fundamental equity saw $5.5 billion in outflows.
A huge divergence. Money pouring into the cheap passive stuff and leaking out of the expensive active stuff.
It confirms the whole industry fee pressure story. Invesco is surviving because they have this massive ETF lifeboat, but it does lower their overall revenue yield.
So they have to make it up on volume.
Exactly.
But there was one active area that was a huge surprise. The most interesting data point in the whole deck, maybe, China.
A major contrarian signal. We hear so much doom and gloom about China's economy, but their joint venture there, Invesco Great Wall, had a monster quarter.
What's the number?
$8.9 billion in net long-term inflows.
In one quarter.
Yes, that's a 36% annualized organic growth rate.
That's insane. What are Chinese investors buying?
It's what they call fixed income plus strategies. So think of it as a cautious reentry into risk. They're balancing fixed income with some enhanced equity exposure, a yield play with some upside.
So while we're all panicking about China, the domestic Chinese investor is putting almost $9 billion into Invesco funds. That is a massive disconnect.
It is, and it shows the value of a global footprint. If Invesco was just a U.S. active manager, this quarter would have been a total disaster. China bailed them out.
And the other growth engine they talked about was private markets, the capital light strategy.
Right. Instead of buying companies, they're partnering. They've got deals with Barings and LGT Capital to distribute private credit and real estate products through their massive U.S. wealth channels.
Is it working?
Seems to be. They highlighted their Incret real estate debt fund. It's now on 3 of the 4 major U.S. wealth platforms and hit $4.7 billion in assets.
That's real money. So when you step back, management is saying milestones, record AUM, unlocking value.
And the market is hearing impairment, GAAP loss, expense complications. The stock is in the penalty box. The market is saying, prove it.
Show me the money from this new QQQ structure.
Precisely. They need to prove the transition actually works.
Which brings us to our favorite part of the show, and this is where we throw out the big disclaimer.
This is not financial advice. We are not your advisors. Please do your own diligence.
But if we were pitching a wild trade idea based on this call, here it is. I'm calling this one the bad accountant reversion trade.
I like it. What's the thesis?
The thesis is simple. The algorithms saw the headline loss and the word impairment and just pukes the stock down 5%. But the impairment is a ghost. It's non-cash history. The future is the QQQ revenue stream, which is a cash cow that just got turned on.
So you're betting the market reprices that cash flow once it sees it.
Exactly. Leg 1. You go long IVZ. You're buying that QQQ fee stream at a discount because of messy accounting.
Okay, what's the hedge?
Leg 2. You short a pure play active manager, find a company facing the same $5 billion in active outflows, but one that does not have a massive ETF lifeboat like the QQQ to save it.
So you isolate the QQQ fella.
Isolate the alpha, or if you want to get really spicy,
Here we go.
the China reopening proxy trade.
Go on.
Everyone's afraid to own Chinese stocks directly because of regulatory risk, right? But Invesco just pulled $9 billion out of China in one quarter. If you believe the Chinese consumer is back, going long IVZ is a stealth long China trade.
Through a U.S. domiciled company that pays a dividend and has a clean balance sheet.
Exactly. It's the safe way to play a risky thesis.
That's actually pretty compelling.
I try. So let's bring it all home. Conclusion time. Invesco Q4 was a kitchen sink quarter. They took the write down, sold the non-core assets, and turned on the QQQ money machine.
It was a necessary reset. But 2026 is going to be messy. You're going to see higher expenses from all these transitions before you see the benefits. But the key is the balance sheet is fixed.
The survival risk is gone. Now it's just an execution story.
And the question for you, the listener, is this. Do you believe the adjusted growth story? Do you believe that 62-cent EPS number is the real baseline?
Or is that $1.8 billion write-down a sign that the legacy active business is eroding faster than the new ETF business can grow?
Is the eraser moving faster than the pencil? That's the story for 2026.
We will be watching the next tick. Thanks for listening to this deep dive on Talk Tickers. Check out the show notes for the full breakdown. See you on the next tick.